Hi, everybody. This is Damon King, certified financial planner and wealth management specialist with Chapelwood Financial Services. And in this short video, I want to address a question that we get pretty frequently, but I so rarely ever see an actual good explanation and a simple explanation to this question. And that is, why do interest rates and bond prices move opposite of each other? You have probably heard many times that when interest rates go up, bond prices go down, and when interest rates go down, bond prices go up. You understand that this happens, but what you may not understand exactly why it happens. So today I want to explain in pretty simple terms why you see this inverse relationship between interest rates and bond prices. So let's look at an example. Let's say that you go out and you buy a bond for $1,000. And when you purchase that bond, you are going to get a 5% interest rate. Now, about a month later, that same bond is available at $1,000, but this time it pays a 6% rate of interest, and your friend buys it at that time. Now, your interest rate is not going to go up to 6%. Your interest rate is locked in at 5%. However, would you go out and spend the same $1,000 for a 5% bond that you could spend to get a 6% bond? Get an extra 1% of interest. You wouldn't do that, right? You would expect to pay less for a bond paying less interest. And that's exactly what has to happen in this situation. In order to equalize the ratio of the price to the interest rate paid, the price of your bond must go down. So that's what happens with your bond. You still get 5% and your friend still gets 6%. However, the value of your bond must go down in order to equalize out that value. Now let's take a look at another example. What if interest rates go down? So in this example, you buy a bond for $1,000 and it pays 5%. Your friend buys the same bond next month for $1,000, but now it's 4% instead of 5%. So would you expect to pay the exact same for a 5% bond as a 4% bond? No, you would expect to have to pay less. Well, now your bond is worth more, right? Because it pays a higher rate of interest. So in this case, because interest rates went down, the value of your bond must go up in order to maintain that same price to interest rate ratio. So this is exactly what happens when bond prices go up and down. It's because interest rates change. Now, how can you use this action to your advantage, or what do you need to know about it? Well, when you purchase a bond, what are you doing? You are making a loan to the entity that issued the bond, whether it's a company, a city, a utility, a school district, whatever. You expect to get that interest plus your money back that you put in, right? It's just like a loan. You expect to be paid back. The longer the term of the bond is, the more susceptible its price is, going up or down, depending upon which direction interest rates go, all right? So if you want a bond portfolio that is less susceptible to a change in interest rates, then you want to shorten the term or the duration of that bond. In an environment like we have right now where interest rates are fluctuating, we are actually trying to shorten the term or the duration of our bond portfolios so that our clients hold shorter term bonds, and therefore there is less susceptibility to changes in interest rates. That's one way that you can try to immunize a portfolio, a bond portfolio, to shorten the duration or the length that you hold those bonds, whether it's individual bonds or a bond mutual fund. And the shorter the term is, the less susceptible those bonds are to changes in interest rates. So, hope you enjoyed this video. If you've got any other questions about bonds or really anything else related to investing or retirement in general, give us a call at 405-348-0909. You can also email us at office@chapelwood.com. Also, if you have not subscribed to our channel here on YouTube, please do so. Click that subscribe button and also hit the notification button. You'll get a notification every time we put out a new video. And as always, you can enroll in one of our upcoming financial education courses, Rock Your Retirement. 4 hours of education spread over 2 nights. We're doing all those classes online, virtually through the rest of 2020. Click the link down below. You can get enrolled in that class and do it from the comfort of your own home. Thank you so much for watching. We'll see you next time.